Good evening, students. Welcome to the session. Yes. So have you revised ATIA, ATIB and all of those sections that we have done? Good evening, Viraj. Yes. Have you revised ATIA and ATIB? Yes. Good evening, Sailesh. Any questions under ATIA, ATIB? I'll just quickly recap whatever we have done so far in ATIA, ATIB. So if you remember, we had the discussion around the basically two important things that I'm going to touch upon. One is that the set off of the eligible business loss can be done against the non-eligible business as well under ATIA, ATIB if you are claiming a deduction. So inter-head set off under section 70 is permissible. Intra-head, sorry. But when you're claiming the losses of the eligible undertaking with the non-eligible undertaking, you have to be mindful about that the losses you have to consider as if it is the only source of income. You have to assume, you have to deem that the while computing the deduction under ATIA, ATIB, all of these sections, it is the only source of income. So therefore, you will first set off the losses against the income which is remaining, and the remaining income after the set off of the losses will only be eligible for the ATIA, ATIB deduction. Are we clear? That is number 1 point. As far as the set off of the losses of the non-eligible business against the eligible business, even that can be done. But again, while computing the income, you have to be very, very mindful that you will consider that this is the only source of income. This income, which is eligible for section ATIA, ATIB provision, is the only source of income. 1 second. So this is the only source of income. Are we clear about that? So you have to be very, very careful then in that particular case, your total deduction under ATIA, ATIB should not exceed the gross total income. So let's say, for example, if I'm claiming the losses, I can claim the losses. Then it shall not be the case that ATIA can be claimed only for the balanced income. ATIA can be claimed for the entire total income. Are we clear? Yes or no? So these were the two important points that we had to discuss. Third important point was that if your income which is subject to ATIA, ATIB is enhanced because of the disallowances, you would still be eligible to claim ATIA deduction or ATIB deduction against the enhanced income. Are we clear? You can claim the particular deduction against the enhanced income as well. So these were the three important points that we discussed. Any questions so far as with regard to the last lecture? Yes, good evening, Vanshika. Good evening, Geeta. Okay. Have you revised and are you clear about these points? Because these are the only kind of, major questions that one can expect out of these particular income-based deductions. And then, of course, if you remember, we had done the ATQQB, ATRRB, all of that sections as well. We have done away with. Now, last one point which was remaining was section 10AA under this. Before we move to the assessment of various entities, deduction under section 10AA. So now with respect to the deduction under section 10AA, now what is this particular deduction available with respect to which category of income? So this is also though covered under 10AA. This is not an exemption. This is particularly a deduction provision only. It is not a Chapter 60 deduction. It is a separate provision in itself. Section 10AA. Now, what does Section 10AA provides for? So, Section 10AA is with respect to the SEZ manufacturer. So, a person who manufactures under the SEZ or provides the services under the SEZ. So, this is basically available to a unit of the SEZ. So, just write down over here the eligible assessee, the eligible assessee in this case is the SEZ. Unit in the SEZ. Unit in the SEZ. Now, what is the kind of deduction which is available over here? So, in the 10AA, the units of the SEZ which are there, these are eligible for the deduction under 10AA if they are engaged in manufacturing, or production or provision of services So, they should be engaged in the manufacture or production of the articles or things or providing any services. Now, this was available to the manufacturing units up till 2021 assessment year. Up till 2021. So, they had to obtain the letter of approval from the SEZ authorities on or before the 31st March 2020. And the manufacture, if it is not commenced on or before 31st March 2020, for them the date has been extended till 31st March 2021. But the letter of approval has to be obtained. Are we there? Okay. Then in this particular case, the deduction will be available if the assessee is exporting these goods or services. So, plus export of goods or services. Now, the export proceeds should be realized within 6 months. Within 6 months from the end of the previous year. Within 6 months from the end of the previous year. Clear? Now, what is the deduction which is available? Deduction in this case is available with respect to the profit and gains from the export business. So the deduction is with respect to the profits derived from the export business. Export of the articles or the export of the services. Now, what is the deduction which is available? Profits of unit in SEZ. How will you determine what is the profit derived from the export business? Into export turnover divided by the total turnover. So this will give you the profits derived from the export business. Are we clear? Yes. So it could be with respect to the sale of goods as well as the provision of the services, including the sale of the computer software. However, in respect of the export turnover and the total turnover, what shall not be considered? So consideration received in respect of the export. That consideration has to be realized within 6 months from the end of the previous year in convertible foreign exchange. However, it will not include, so exclude the freight, exclude the freight, insurance, or the telecommunication charges. So this has to be excluded. So freight, insurance, telecommunication charges, which is attributable to the delivery of the goods or the services, that has to be excluded. Are we clear? So the export turnover means what? The consideration which is received in convertible foreign exchange within 6 months from the end of the previous year. But it will not include freight, telecommunication charges, or insurance attributable. Are we clear? Plus the charges for the rendering services outside India. So any other charges which are incurred for rendering services outside India are to be excluded. Okay? So you can add or charges for rendering services outside India. So what is export turnover? Export turnover means the consideration in forex. Consideration in forex realized within 6 months from the end of the previous year. Now, once you exclude from the numerator, from the export turnover, do we also have to exclude it from the denominator as well? Yes. So in this case, the CBDT has clarified that this will be excluded both from the numerator as well as the denominator. So it is not that you will only exclude it from the numerator. You have to exclude it both from the numerator as well as from the denominator. Be very, very careful for this particular point. Yes. So for the 10AA, the export proceeds are what? The export proceeds are the foreign exchange consideration which is realized, and that has to be considered, which is realized within 6 months from the end of the previous year. And you have to exclude the freight, you have to exclude the insurance and any telecommunication or other charges, as well as any expenditure incurred in foreign exchange for the any expenditure which is incurred outside India. And that has to be excluded from both, from the export turnover and from the total turnover as well. This has been clarified by the CBDT as well as the Supreme Court ruling in HCL Technologies Limited. So you can write here, exclude from both numerator as well as denominator. And in bracket, you can write down CBDT circular. Yes, is it clear? Now, but the question still arises. What is the quantum of deduction which you are getting? We understood what is the meaning of export turnover, total turnover. We understand that. But what is the deduction which is allowed? So, amount of deduction here will be, for the first 5 assessment year, For the first 5 assessment year, beginning with the first assessment year when the unit begins to manufacture or provide the services, 100%. 100% of the profits derived from export. For the next 5 assessment years, it shall be 50%. Okay, it shall be 50%. So 50% and 100% and 50%. Okay. So first 5 years, 100%. Next 5 years, 50% of the profit. Clear? Yes or no? Any question? So let's say, for example, if an undertaking begins to manufacture, then the deduction under 10AA will be 100% for the first years when it is beginning to commence and 50% for the next 5 years. And after that, it will also get 50% provided for the next AYs or the next AYs which are there after the 10 years, or you can write after 10 years. %, but subject to amount credited to special account. You know, we had some special account in the 33AB ABA for the tea, coffee, rubber development where we used to contribute to a special account. Here also you have to do like that. So there are certain conditions that the amount has to be credited to a special economic zone reinvestment reserve account, which is again to be utilized only for the purpose of acquiring plant or machinery, which is again to be put to use before the expiry of 3 years. It should not be utilized for distribution of dividend or for remittance outside India or for creation of any asset outside India. And in case you do not utilize the amount as we had it under 33AB, then it shall be deemed to be the income. Or if you misutilize the amount, it shall be deemed to be the income. Okay, so just write down to be utilized within 3 assessment years for plant and machinery. Not to be utilized for dividends or creation of asset outside India or a remittance outside India. Non-utilization within 3 years or misutilization shall be deemed income. It shall be treated as the deemed income. Further, here also you are required to mandatorily file your return of income as well as the audit report. So, ROI plus audit mandated. Just like ATIA, ATIB, where section 80AB itself requires you to file the return of income. So if you remember, I told you that for all the 80 sections which are based on the chapter 6A deductions, which are based on the part C, which are deductions for the deductions based on the income, it requires you to furnish the return of income. So section 80AC provides that any deduction shall not be admissible unless the return is filed under 139(1), that is before the due date. Otherwise, you will not get any deduction. Similarly, under 10AA also, you can only claim the deduction provided you file the return of income as well as the audit report before 1 month prior to the due date of the 139 month. So audit report, let's say by 30th September and then return by 31st October. Clear? So that is mandatory within the due date. Yes, are we clear? Any questions, any doubt? Yes or no? Yes. So if you claim the deduction under 10AA, you will not get any other deduction then. Okay. So you can only claim this particular deduction. Yes. Any doubt? Again, here the transfer pricing or the fair market value condition which is there, that the goods should be transferred from the eligible undertaking to a non-eligible undertaking or vice versa at the fair market value. And if the transaction value is more than 20 CR, it will become specified domestic transaction and then transfer pricing will become applicable. Clear? So just write down. If transfer of goods or services between 10AA unit and non-eligible unit at the fair market value. TP applicable if the transaction value is greater than rupees 20 crores. Yes. Also, in the case of amalgamation, this will be available to the amalgamated company. Amalgamated company can claim the deduction for the balance period. Yes, students, is it clear? Yes or no? Any questions? Any doubt? Yes. Prerna, we have to just, as I said, we have to file the return of income and the audit report mandatorily by the due date under 139(1). So, of course, audit report 1 month prior to the due date, but the return of income under 139(1). And audit report under 44AB prior to the due date of the return of income. Yes. Any doubts, any questions? Is this particular provision clear? Okay. So this is about 10AA. Also, if you remember under ATIA, ATIB, I told you one more important thing just to give you a recap. What is the profits derived from the undertaking? You will consider the subsidies as the profit derived from the undertaking because that is reducing your cost of providing the goods or services. But the duty drawback is an incentive under custom scheme and therefore that is not considered as profit derived from the undertaking because it is not affecting any of your cost. Right? So that point also we have discussed. Also just last point, you can write it over here for ATIA, ATIB. Section 80 AC requires that ITR or ROI to be filed before the due date under section 139(1) for claiming the deduction under Part C, Chapter 6A. Okay, which are the income-based deductions. Also, one last, just a kind of referencing that I'm trying to make is with respect to ATIA, ATIB. What did I told you? You can claim the losses of the eligible undertaking against the non-eligible undertaking and vice versa. Because intra-head set-off is permissible under section 70. Whether you can claim the losses of the non-eligible business against a business for which you are claiming 3580. Did you get my question? So can you claim the losses under specified business under 3580 against the other business? And can you claim the losses of the non-eligible business against the 3580 business? That is the question to you. For ATIA, ATIB, what did I say? You can claim the losses. You can claim the losses from one undertaking against the another undertaking. But can you claim the set-off of the 3580 business against the non-eligible undertaking and vice versa situation? Yes, students. Prerna, no? Okay.
Play from Harshad PC.
Yes. Whether we can claim, whether we cannot. Mohammed, we can claim. Okay. Geeta, yes, 3580 losses cannot be deducted from the other business loss. But what about the other business loss against the 3580 income? Can you do the reverse situation? So students, we cannot claim the losses under the specified business against the, we cannot claim the losses of the specified business against the other business. That is the restriction created by section 73A, set off and carry forward of the losses of the specified business. But what about the other business loss against the specified business? So, we cannot claim the losses of the specified business against the non-specified business. But what about the non-specified business loss against the specified business income? Yes, Prerna. So we can set off the normal business loss against the specified business income because there is no restriction under 72. The restriction is there under 73 for the specified business loss. So maybe just a small reference, you can write it over here. Losses from the specified business under section 35AB cannot be set off against other business income. Section 73. However, losses from other business can be set off against the specified business income under section 3580. Such restrictions are not there for set off of losses of undertakings claiming deduction under section ATIA IB section 10AA, wherein loss of eligible undertaking can be set off against non-eligible undertaking and vice versa. The only condition there is that this particular income should be considered as the only source of income. So with this, I am ending the income-based deductions other than section 80P and 80PA. Are we clear? And then one more deduction, of course, we are going to do now, which is ATM, which is what we have already done. And which you are going to, just brief me. What was ATM? What was ATM, students? Yes. What was ATM, Pastor? Students, tell me ATM. We have already done that. So I'm just kind of giving you a quick recap to that. What was ATM fast? Yes, Geeta, very good. Dividend income, which is received by one company from another company. So this is for the intercorporate dividend. Refer income from other sources. So I'm just taking you back. You can go back to your notebooks. What we had done for ATM, if you remember. See, deduction under chapter 6A, ATM. So this is allowable to a domestic company which is receiving the dividend from any other domestic company, foreign company, or a business trust. And if it is also distributing the dividend. So while computing the total income of the domestic company, the deduction will be allowed to the extent of the amount of dividend received from the other domestic company or foreign company or the business trust, which will be restricted to the amount of dividend distributed by it on or before the due date. What is the due date for this section? The due date is 1 month prior to the date of furnishing the return of income. So dividend received or dividend distributed on or before the due date, to that extent, it will be getting the deduction under ATM. Are we clear? So let's say, for example, it's received the dividend of 10 lakh during the previous year, 23-24. On, let's say, in April, it is distributing the dividend of 5 lakh. So to the extent of 5 lakh, it will get the deduction under section ATM. Now this will be available to the Indian company irrespective of whether it is opting for 115 BAA or BAB scheme. So generally, all the other deductions are not available under 115 BAA or BAB. But this will be available for even the 115 BAA or BAB scheme as well. Are we clear? Yes or no? So which are the deductions which are available in the optional scheme as well? One is the ATM. ATM. Then which other deduction is available under the optional scheme? Yes, other than ATM. ATCCD2, which is employer contribution to the pension scheme, which was 10% of the salary. Do you remember that? Then ATLA, which was for the units in the IFSC, And then ATJJAA. This is what we are going to do next. So, which are the deductions which are available to the um, uh, optional scheme regime or the concessional scheme regime? You can write it over here. We'll write it at the end after we finish all the deductions. Okay. Next is deduction under section 80 TTA and deduction under section 80 TTB. Yes, 80 TTA, 80 TTB. Yes, Geeta, very good. So 80 TTA, 80 TTB is in respect of the interest income. It is in respect of the interest income. Now, what is the deduction available over here under 80 TTA? First, here it includes for the individual or HUF. So eligible assessee is individual or HUF. Individual or HUF. Here, what do they get is the deduction is on the interest in a saving account and not fixed deposit. So eligible income is interest in the or interest on the saving bank account, not fixed deposits. And this saving bank account can be with a bank, can be with a cooperative bank, cooperative society, or a post office. Now, what is the deduction over here? Up to rupees 10,000. So, interest income or rupees 10,000, whichever is lower. Okay. So, if the income is derived from any deposit in a saving account, which is, let's say, held by a firm or AOP or BOI, then the partner or the member of the AOP or BOI will not get any deduction for that interest. So deduction is only allowed to the individual who has kept the deposit in the saving bank. Fine. Now, ATTB is with respect to a senior citizen, which is a resident individual who is greater than equal to 60 years. So he should be a resident. He should be a resident. Now your interest on savings plus fixed deposit, both are covered. It could be with the bank, it could be with the cooperative society, it could be with the post office. And what is the quantum of deduction? Up to rupees 50,000. So up to rupees 50,000, this deduction will be available. But these are available only when they do not exercise the 115 BAC schemes. Yes. So this is about 80 TTA TTB. Last one is 80 JJAA. Now this is not based on any income category. It is not based on any income category. This is for the employment of new employees. So deduction in respect of employment of new employees. Now, who is the eligible assessee over here? Here the eligible assessee is to whom tax audit is applicable under section 44AB. So one who is doing the business and who is to whom the tax audit is applicable under section 44AB. What is the requirement of tax audit? To whom the tax audit is available, students? Yes. To whom the tax audit is available? Who is liable to do the tax audit? We have done that. Yes, students. Yes. Yes, Geeta, that is correct. So, tax audit is applicable. We have done that. The tax audit provision, to whom it is applicable. So, if you remember, for the tax audit, which is applicable is if your total sales or turnover or gross receipts exceed rupees 1 crore. But if you have cash receipts less than 5% of total receipts or cash payments less than 5% of total payments, then the turnover criteria is 10 CR. Plus, if you are opting for 44AE, 44BB, all of that provisions, presumptive taxation, and if your profits are lesser than that, or if your business is there under 44AD and 44AD4 is applicable, meaning you're going as per presumptive section and then you are opting out of it. You're not declaring as per presumptive. And your total income exceeds the basic exemption limit, then you're required to do the tax audit under 44AB. So these were the provisions for the tax audit, right? So basically an assessee who is covered by the tax audit, that is the assessee which is eligible for deduction under 80JJEE. Now, what are the other conditions which are there? Just write down that the assessee, sorry, to whom the tax audit is applicable. What are the conditions? The first condition is that the new employees should be, or the additional employees should be hired. So the assessee should have hired the additional employees. The assessee should have hired the additional employees. Now, what do I mean by assessee should have hired the additional employee? Now, additional employee meaning that the new employees should have been hired. But there are certain employees which are excluded from the additional employees. So this excludes, this particularly excludes, what is excluded from the additional employee? The employees whose salaries are greater than rupees 25,000 per month. Employees whose salaries are greater than rupees 25,000 per month. Employees for whom the contribution is paid by the government under the EPS or EPF scheme. So basically the employees which are there for whom the contribution is paid by the government under the pension scheme. So which are basically the government employees. who are covered by EPS or EPF, where contribution is paid by the government. Okay. Third one are the employees who do not participate in RPF. Not covered by a recognized provident fund. Employees employed for less than 240 days. Employed for less than 240 days. For the manufacturing of apparels and footwear business, manufacturing of apparels or footwear or leather products business, this should be considered as 150 days. This should be considered as 150 days. So if the employee is employed for less than 240 days, then in that particular case, they will not be covered for the 80JJAA. However, if the employee is employed for less than 240 days or the 150 days during the current previous year, but in the succeeding previous year, he is employed for more than 240 days. So in the current year, he is employed for less than 240 days. When the next year he continues his job and is employed for greater than 240 or 150 days, then 80JJAA deduction for such employee available in succeeding previous year. It shall be available in succeeding previous year. Are we clear? Yes? Clear? So the employee which is additional employees, for them this particular deduction is available. What are the additional conditions? The business should not be formed by reconstruction or splitting up of existing business. Meaning it should be a new business. Okay, business should not be formed by splitting up or reconstruction of an existing business. The business is not required. Sorry, the business is not acquired, not required. Business is not acquired by way of transfer or reorganization. So as I said, it should be a basically new business. Plus the audit report should be furnished. Tax audit report to be furnished within the due date under section 44A. Okay. That is 1 month before the due date of filing of return of income. Now, what is my deduction under 80JJAA? The deduction under 80JJAA is 30% of additional employee cost. 30% of additional employee cost. So we understood what is the additional employee. So employee cost meaning whatever salaries which are paid to that particular employee. So for the increase in the number of employees with regard to the comparison to the last total employees that we had, whatever salaries are paid to them, that is particularly going to be considered. However, we will not include the salaries which are paid in cash. So it has to be paid by the account paid check, account paid bank draft, ECS, or the electronic payment mechanism. Clear? So, additional employee cost, salaries, or total emoluments paid to the additional employees. Salaries in cash or cross check not to be considered. Fine. Yes or no? So whatever sum is paid to the employee for his employment, that is basically going to be considered. Of course, the employer contribution to the PF, to the pension fund, that is not considered. Okay. Employer contribution to PF or pension, not considered. Similarly, any gratuity payments or any lump sum payment for termination of service, leave encashment, VRS, those are not considered. Fine? Yes or no? Any questions? Any doubt? Yes, students. So with this, we are completing all the deductions. Fine? Now just write down at the start of the chapter which deductions are available when you claim the optional regime. So you can write it over here. Deduction under section 80JJAA, 80LA, 80M, 80CCD2 available even under concessional tax regimes. Rest deductions are not available under concessional tax regime. Yes, students, any questions, any doubt with respect to the Chapter 60 deduction? I'm giving you 5 minutes time. You can go through the chapter and let me know in case you have any questions. So this also completes your entire first module. Yes, which comprised of 8 chapters. And now we are proceeding towards the assessment of various entities. Yes, just go through it once. Yes, students, any questions? Is this clear? Okay, so let's move further towards the assessment of various entities in case there are no doubts. Let's start the next topic. Write down assessment of various entities. In this, what all we are going to cover? First is with regard to the companies. Second is with respect to the, or let's do it like this. First is with regard to the individuals, then the companies, then the partnership firms, then with respect to the AOP or the BOI, and next is cooperative society. Okay, so this is what we are going to cover in this particular chapter. And of course, the last one on mutual concerns. Now you will observe much of it we would have already done by now. We have already done by now many of these things already. Of course, one last one which I missed is the HUF. Or let me put it at the last only. Okay. So all the different kind of persons we are going to cover over here. So first, starting ahead with the individuals. Yes. So you're going to tell me what is the taxability for the individuals. Okay, before we move towards the individual, in the chapter 6A, one point which I wanted for you to write is, not in the chapter 6A, in the capital gains. In the capital gains notebook, just I want you to make a reference for the amalgamation and demerger. In the amalgamation and the demerger, you can just write it down here that section ATIA, ATIB deduction 10AA available to amalgamated company. Okay. So you can just make a reference under amalgamation and demerger because that will help you remembering that. Here also you can write ATIA. No, under amalgamation only that is applicable, not under demerger. Sorry. Okay. So this one point just you can make a reference. Yes, under demerger as well. You can write it down. Section ATIA, ATIB 10AA available to the resulting company. Clear? Yes or no? Okay. Now you move towards the assessment of the various entities. So yes, first for the individuals. What is the tax rate for the individual students? Yes, students. Yes, students. What is the tax rate for the individuals? We have already done that in the first basic concept chapter. Yes, tax rate for the individuals. Faster. Slab rate. Now I know that it's slab rate, but which are the two concepts that we have dealt with? What are the two schemes which are available to the individual? Yes, the basic concepts class. We have already done all of this in very detail. Yes, for the individual, you have the concessional tax rate under 115 BAC as the default tax regime, right? So for the individuals, HUFs, AOPs, other than the cooperative society as well as the BOI and the artificial juridical person, the default tax regime is going to be the concessional regime under 115 BAC. I'm just quickly recapping it for your reference. Yes, Vanshika, very good. So they have to pay the tax at the concessional rate under 115 BAC. These are the default tax regime unless the assessee decides to opt out for them. Unless the assessee decides to opt out for them. And what are the slab rate, students? Yes, the slab rates are up to 3 lakh, it is nil. 3 lakh to 6 lakh, uh, 3 lakh to 6 lakh, it is 5%. And 6 lakh to 9 lakh is 10%. 9 lakh to 12 lakh, it is 15%. 12 lakh to 15 lakh, 20%. And then over and above 15 lakh, it is 30%. Right? So these are the tax rates which they have to pay. Now, this is other than the income which is chargeable at the special rates, which is under 111A, 112, 112A, 115BB, all of those sections. Those are going to be charged at the special rate only. And with respect to the incomes which are chargeable at the special rate, those are going to be taxed at those rates itself, right? Now, what are the conditions which one has to satisfy if concessional tax regime is to be claimed? So, for the concessional tax regime, you will not get any deductions or exemption, which is, for example, the leave travel concession, the house rent allowances, the special allowances under section 1014, which are basically granted to meet the expenses relating to the duties of the employment. But what is allowed is the traveling allowance is allowed. So conveyance allowance is something which is allowed, plus the transport allowance of rupees 3,200 per month to an employee who is deaf or blind or handicapped. So these allowances are allowed. So traveling allowance, conveyance allowance, traveling allowance is basically granted to meet the cost of travel on the tour or transfer. The conveyance allowance is basically granted to meet the expenditure incurred on conveyance in performance of the duty, and the transport allowance is only for the handicap. And of course, there is one daily allowance which is again granted on tour for daily charges. These are allowed. Okay. Then individual would not be entitled for free food and non-alcoholic beverages vouchers which are given. That will not be allowed. That will not be allowed. So food coupon voucher is not allowed. Okay. Then exemption for minor child under section 1032, that is something which is not allowed. Then daily allowance for the MPs, MLAs, that is not allowed. Tax holiday for units established in SEZ, that is not allowed under 10AA. Then, so that I have already written chapter 6A deductions, plus you can write it over here 10AA as well. Okay. Then entertainment allowance, professional tax, that is not allowed. Standard deduction is but allowed. So standard deduction is something which is allowed. Interest on loan in respect of self-occupied property, that is not allowed. But interest on loan on the rental property is something which is allowed. Then additional depreciation, then the 33 ABT coffee rubber development, site restoration fund, deduction in respect of contribution to the research association, university, national laboratory. So that is not allowed. But what is allowed is The scientific research expenses, either revenue or capital expense, which has been incurred by the company for the research to be carried out, that is something which is allowed. 35AD, 35CCC, those are not allowed. 80C to 80U, that is not allowed other than 80CCD2 and the 80JJAA for the individual. It cannot carry forward, and yes, of course, the depreciation is allowed. The additional depreciation is not allowed, but the depreciation is allowed. Then it cannot carry forward and set off any losses which are pertaining to the deductions which are not allowed. And the losses under the head house property with the any other head of income. So any current year losses, the interest on self-occupied property is any which way is not allowed. Then interest on the rental property, interest on the let out property, that is allowed. But if it is in excess of the income, then it will not be allowed to be set off against any other head. So just you can write it over here, set off of house property loss against any income in case of let out property. Because for the SOP, interest is any which way is not allowed. Clear? So all of the losses will be allowed to be carried forward. Okay? So these are the points which you have to remember. Yes? Any question, any doubt? And then where the income tax is on the block of asset, then in that particular case, the additional depreciation will not be allowed. Additional depreciation will not be allowed. Only the normal depreciation is allowed. So if there is any additional depreciation of the earlier previous year, and if you are going for the default tax regime under 115 BAC for the previous year 23-24, then the amount attributable to the additional depreciation which is remaining unabsorbed of the earlier years would also not be eligible for set off during the current year, and at the same time the WDV of the block of assets will also get increased. So let's say, for example, if I have the unabsorbed depreciation of previous year 22-23 in respect of the additional depreciation, and this year I will be not opting out of 115 BAC. So if I am going as per 115 BAC only, then the additional depreciation which is there will not be allowed to be carried forward and set off this particular year. And at the same time, I will not get deduction even in the future year. At the same time, the WDV of the block will also be increased by the amount which is not allowed to be set off. So I've written here add to the WDV of the block of assets. Now, if you want to opt out of the default tax regime, other than the business or profession, you have choice each year, you have available. You can opt out and you can exercise that choice before the due date of return of income. But if the assessee is having the business or profession, then you have choice only once. So before the due date of filing the return of income, you have the choice to opt out of the default tax regime. Otherwise, if you have not opted out, then the option will apply to all subsequent years. And only once you can withdraw. Only once you can withdraw. Sorry, you can withdraw once and you can again only go back once. So if you have the income from the business or profession, the option has to be exercised before the due date under 139(1). And once the option is exercised, you will have to apply it to all the subsequent year. And the person who has come out of the default tax regime, he shall be able to go back to the scheme only once. Then once he has go back, then again that will apply to all the years. Thereafter, he will never be able to exercise this option again. Clear? Then AMT is not applicable for the 115 BAC regime. Are we clear? Yes? Any questions, any doubt? Then in respect of the normal tax regime, if you are opting out of that, you have the normal tax regime, which is the optional regime now. Up to 2.5 lakh nil, 2.5 to 5 lakh 5%, 5 lakh to 10 lakh 20%, and greater than 10 lakh 30%. For the resident individuals greater than 6 years, you have a higher slab of 3 lakh. And for the resident individual greater than 80 years, you have a higher slab of basically the 5 lakh. Plus, you have the rebates which is available under both the scheme. So, rebate under section 87A, it's not 7A, it is 87A to a resident individual, rupees 12,500 for income up to rupees 5 lakh. And under the concessional tax regime, it is 25,000 for income up to rupees 7 lakh. Yes. So the tax rate for the concessional tax regime, you have to forgo all the exemptions other than the ones which are specifically allowed to be claimed. And that is the default tax regime. If alternatively, you can just exercise to shift out of the default and pay the tax under the normal tax regime, which is now the optional tax regime as per the slab rates which are given. Yes or no? So this is going to be the case. Then, as I said, the rebate is which is available to you. That is something which we have discussed already, which is 25,000 in the new tax regime which is there, and in the old it is 12,500. Also, this is rebate which is available only to a resident individual. Rebate is available only to a resident individual and not to a non-resident individual under both the scenarios. Then what will be a surcharge? The surcharge basically which is available, is different again for both the regime. Here it is 10%, 15%, 25% and 37%, and the highest surcharge on LTCG, STCG is 15%. So if your total income exceeds 1 crore but is less than rupees 2 crore, including the LTCG, STCG, it is 15%. Only when your total income, excluding the LTCG, exceeds rupees 2 crore, you have 25% surcharge. And for the default tax regime, which is there, the highest surcharge is 25%. 37% is not applicable in that scenario. Clear? So under the default tax regime, the maximum rate of surcharge is 25% for total income exceeding rupees 2 crores. Any questions? Any doubt? Yes, students. For the individual. Okay. So this is for the individual. Now with respect to the individual, last 1 or 2 points which I want to cover, which is part of your module itself. Now with respect to a non-resident individual, that we are going to cover. Under the individual, we have resident as well as non-resident. For non-resident, we will be separately covering in detail in the non-resident tax module, in the taxation of the non-resident, because their tax rates are very, very different. Now, in respect of the individual, you get the rebate. The rebate basically under 87A we have covered. There is also the rebate which is available with respect to the, or relief which is available with respect to the income from retirement benefit account, which is maintained in the notified countries, which is UK at the moment. So that again we will cover in the non-resident tax class. So that is again we are going to cover over there. The rebate and relief with respect to that. So till now, the individual taxation is what looks like. You have the 2 taxations which are there. One is the default, second is the optional. Fine. So with this, we'll take a break of 10 minutes and then we get back and we start with the company taxation. Fine. So let's take a break of 10 minutes. Now moving towards the company. So tell me, what are the provisions for the company, students? We have again done that. Yes, for the taxation of company. First of all, tell me, what are the different kinds of company? Yes, students. First, tell me different kinds of company. We have Indian company. We have something called as foreign company. We have domestic company. Then we have the closely held and the widely held company. So what is an Indian company, students? This distinction is very, very important. If you remember, I had told you that point of time itself. It's very important. Yes. What are the different kinds of company? What is a domestic company? Yes, students, fast. Fast students, I don't need to know the answers. Yes, correct, Vanshika. But what is an Indian company? Yes, what is an Indian company? Yes, Vanshika, correct. Domestic company means Indian company and the company which has made the prescribed arrangements for the declaration and payment of the dividend. Very good, Vanshika. But what is an Indian company? Yes, Pastor, I'm not getting the answers. Yes. So Indian company is basically which is incorporated as per the Companies Act. The Indian company is one which is incorporated as per the Companies Act. And then we have the domestic company which has the Indian company plus the company which has made the prescribed arrangements for the declaration and payment of dividend. What do we mean by the prescribed arrangements? Means it has a share register in India. It conducts the general meeting for declaration of dividend in India, and it has declared the dividends which are payable only within India to all the shareholders. That means it has made the prescribed arrangements. So even if it's a foreign company, if it has made the prescribed arrangements for dividend declaration in India, it will be the domestic company. Now, why the distinction between the domestic and the foreign company is important? Because the domestic company has a different tax rate than the foreign company. So that is why it is very important to distinguish between the domestic and the foreign company. Then what is a closely held and the widely held company? Closely held company are basically which is not a widely held company. So therefore, what is a widely held company? A company which is owned by the government, a company which is the NPO, a company which is mutual benefit finance company, or a company whose equity shares are held by the cooperative societies, or which is a listed company, and the subsidiary of the listed company is also considered as the unlisted company which is there, which is a subsidiary of a listed company, that is also considered as the widely held company. So therefore, a private company will always be treated as a closely held company plus the unlisted company, which is not a subsidiary of the listed company. Now, why is it again important to distinguish between a widely held and closely held company? Because there are certain provisions which are applicable only to the closely held company, which are basically in the nature of 222E. You can write down the examples for that. Provisions applicable to closely held company. Section 222E, deemed dividend. Section 5627B, issue of shares at the premium. Then Section 68, where The amount is received as a share application money or share capital, and where the company as well as the investor is required to prove the nature and the source of the amount. Section 79, change of ownership for the carry forward of the losses, and section 179, which is liability of the directors of private company. So these are the provisions which are only applicable to a closely held company. Now, what are the tax rates which are applicable for the company? The tax rates that we, if you remember, we had done the tax rates which are applicable only for the company. What are the tax rates? The tax rates which are there are basically these ones, which is for a domestic company, you have the normal regime, which is the tax rate of 30%. And for the small companies which are having the turnover less than 400 crores, 25% turnover of previous year 21-22. In these cases, the surcharge which is to be considered is between 1 to 10 crore. If the total income is there, 7%. Beyond 10 crore, it's 12%. Then for the manufacturing companies, you have section 115 BAB regime. So under 115 BAB regime, which is concessional tax rate of 15% plus surcharge of 10% plus cess of 4% to the new manufacturing or electricity generating domestic company which are set up and registered in India on or after 1/10/2019 but before 31st March 2024. And the domestic company should not claim the certain profit linked deductions. What are those? So this is total 17.16%. Now, in this particular case, they have to forego the deduction. So what are the deductions that they have to forego? They have to forego several deductions like the 10AA exemption, additional depreciation, then the 33AB, 33ABA, which is tea, coffee, rubber development, site restoration, then deduction for the scientific research, which is there. Again, when the contribution is being made to these association, but the deduction for the scientific research expenditure incurred by the company, the capital expenditure and the revenue expenditure which is there, both are available. Then 35AD specified business deduction, 80C to 80U other than 80JJ8, 80M and 80LA. These are available. Then set off of losses and the unabsorbed depreciation in relation to these disallowed deductions cannot be claimed. However, depreciation, of course, you can claim it. Now, in respect of these particular 115 BAA company, what is the rate of tax? The rate of tax which is there is 17.16%. But if an income is chargeable at the special rate, then the special rate will be there, which is the under chapter 12, which is prescribed, but the surcharge shall be 10% and the education cess will be 4%. So that also we had written over here. Income taxable at special rate will be subject to that, but the surcharge will be 10% and not the 7 or 12%. Then the rate of tax on any other income for which no specific tax rate is there, or the STCG which is derived from the transfer of a capital asset other than the depreciable asset which is there, the tax rate is 25.168%, which is 22% plus surcharge of 10% plus cess of 4%. If the income is neither derived nor is incidental to the manufacturing or production. For example, income from house property, income from other sources, and that is taxable on the gross basis without any deduction of expenditure. For the STCG on the non-depreciable asset, it is again 25.168%, but you will get the deductions for the cost of acquisition. Then the MAT is not applicable for this company. But this company should not be formed by splitting up or reconstruction. It should not be with the old plant and machinery. Of course, there is an exception that the second-hand plant and machinery which is imported is allowed, or if the value of the second-hand plant and machinery does not exceed 20% of the total value of the plant and machinery. It should not be engaged in any business other than the manufacturing or the research or distribution. Manufacturing of the business will not include development of computer software, mining, conversion of blocks, bottling of gas, printing of books. So these are something which are not considered as the manufacturing business. Okay. So this was under 115BAA. This was in respect of the 115BAA. On failure to satisfy these conditions, what will happen? The option will become invalid and the other normal provisions of the Act will become applicable. So if the option is invalid, then it can exercise till the 22% tax rate. Okay. Also, here the transactions between the company which is claiming 115BAB and the other company, the AO can recharacterize the amount of the transaction. Okay, so AO can basically decide to determine the amount of profits, and this will also be subject to the transfer pricing provision. And such an income will be taxable at 30% plus surcharge of 10% plus the education cess of 4%. The exercise of the option has to be before the first return of income that is filed on or before the due date under 139(1). Once the option has been exercised, it cannot be withdrawn subsequently. So this option will be available only for the first return which is to be filed. It cannot be subsequently exercised. And in case the amalgamation happen, the amalgamated company can also will have the same option which is becoming applicable to the amalgamated company. The second tax regime is the 22% tax regime which is under 115BAA. There are no conditions therein. The only thing is that it's a concessional tax regime. You cannot claim all these deductions what we have spoken about. There, of course, the surcharge is again 10% and cess is 4%, making it to 25.168%. Special income will be taxable at the special rate. If there is no rate of tax which is prescribed, then it will be continued to be taxed at 22% plus 10% surcharge plus 4%, which is 25.168%. And this will be not taxable on the gross basis. There is no condition for under 115BAA that the any other income which is not taxed at a specific rate, that shall not be taxable at the gross basis, unlike under 115BAB. Secondly, STCG on the transfer of a non-depreciable asset, again that is also at 25.168%. Here you can exercise the option at any point of time. You can exercise the option at any point of time. There is no restriction that you have to exercise the option in the first assessment year itself. So here there is no condition like that. So you have to exercise the option before the due date of return of income, and once exercised, it will apply to subsequent assessment year and it cannot be withdrawn. Okay, but it can be exercised at any point of time. And if you fail to satisfy any conditions, then in that particular case, the option will become invalid and you will be governed by the normal provisions of the tax. Here also the MAT will not be applicable. Fine. So this was the just recap of 115BAA, 115BAB. Clear? Just a small recap. Now, what's important, which is what we have to start over here, is MAT provisions. Here we are required to understand the MAT provision. Now understand, every company will prepare its profit and loss account in accordance with Schedule 3 of the Companies Act. Now, whatever book profits it is reporting, the MAT is applicable on that book profit plus the specified adjustments. So the minimum alternate tax was introduced for the purpose that, see, what the companies were doing is, they were claiming enormous losses. The companies were claiming the enormous losses and still declaring the dividends. And they were not paying the taxes with the losses that they have claimed. So because of that, the government introduced the minimum alternate tax. For the reason that this minimum alternate tax which is there, this will be applicable for the companies on the book profit with these specified adjustments. So this is applicable to all the companies which are there, domestic as well as the foreign, where the tax as per normal provision is less than 15% of the tax on the book profits. So just write it over here. Applicable to domestic plus the foreign company. This is applicable to both the domestic as well as the foreign company, and where tax under normal provisions is less than 15% of the book profits. Are we clear? So then we have the MAT applicable under 115JB. This is under MAT under section 115JB. So this is again a notwithstanding provision, meaning it overrides all the normal provisions of the Act. It says, where in the case of a company, the tax under the normal provision is less than 15% of the book profits, then book profits shall be deemed to be the book profits shall be deemed to be the total income. Shall be deemed to be the total income. And the MAT on that will be 15% of book profits. Now, if it is deemed to be the total income in respect of the MAT calculations, if it is deemed to be the total income, students, the advance tax, the interest under 234 ABC will be equally applicable even under the MAT. It is not the case you will say I'm going under MAT, so advance tax obligations, interest under 234 ABC is not applicable. No. Even when you go under the MAT, all the provisions will equivalently apply as it applies to the normal income, because the book profits are deemed to be the total income. The book profits are deemed to be the total income. So in that case, all the provisions of the Act will be equivalently applicable. Okay. So just write down over here. Advance tax plus interest under section 234BC are applicable. Fine. Now there are certain exclusions with respect to the MAT. There are certain exclusions which are applicable to the MAT. Okay, one more thing. MAT is 15% of book profit, but here you will have surcharge and cess, which is equivalently applicable. So surcharge and the cess will also apply on this 15%. What will be the surcharge? 2%, 7% and the 12% rate, which is there for the domestic company, and likewise 2% and 5% for the foreign company. So normal surcharge will be applicable over here. Now, there is certain exclusion. As I said, the MAT is applicable to both the domestic company as well as to the foreign company. However, this will not be applicable if the foreign company is a resident of country with which India has a DTAA and the foreign company does not have a PE in India. And the foreign company does not have a PE in India. Secondly, or the foreign company is a resident of country with which India does not have a DTW, but the foreign company is not required to register under the Companies Act. It is not required to seek any registration under the Companies Act. So in those cases, MAT provision will not be applicable. So just write down not applicable, or you can write the exclusions once again. First is foreign company is a resident of country with which India has DTAA and it does not have permanent establishment in India. Permanent establishment means a branch in India. Secondly, foreign company is a resident of country with which India does not have DTAA, with which India does not have DTAA, and it is not required to register under the Companies Act and is not required to register under the Companies Act. Fine. Next exception is there. A foreign company whose total income only includes solely presumptive profits under section 44B, 44BB, 44BBA and 44BBB. And the taxes income is offered to tax in accordance with those sections, in accordance with the rates under those sections. Fine. So these are the exclusions under 115. These are the exclusions under 115 JB. Fine. Now, what are the specified adjustments? How do you compute the book profits? So book profit means what? Book profit is basically your profit which is under the Schedule 3 to the Companies Act, the profit and loss account which is prepared. So the profit as per the books of account. And book profit computation. The book profit computation. So basically what it says is the book profit means the book profit as per the books of accounts which are adopted by the companies under the Company Act. So that is the amount of the book profit that you need to take into consideration. And then of course, you have to make certain adjustments into that. Okay, then you have to make certain adjustments to that. Okay, one more thing. Here you can also write under exclusions for the domestic company. Once for the domestic company also there will be exclusions, right? You did not mention to me. Which are the exclusions for the domestic company? Tax paid under section 115 BAA and tax paid under section 115 BAB. So for the foreign company also we have exclusion. For the domestic company also we have exclusion. Are we clear? Yes. So for both of them we have the exclusion. Isn't it? Now, when I'm saying that the book profits, so I was talking about the book profit. So it says that the assessee as a company has to prepare the profit and loss account as per Schedule 3, and it prepares the profit and loss account as per the accounting policies and whatever the accounting standards are there. So the book profit which is there is the profit which is shown in the profit and loss account, which is adopted by the assessee. So book profit means the profit net profit as per the P&L, net profit as per the P&L, as shown in the P&L, adopted. Fine. And you have to make certain adjustments. So you have to add the, first of all, income tax payable. So add back, let's say for example, if I have the income tax which is there. So explanation 1 to section 115 JB provides for the adjustments. So first is the income tax payable. Let's write it like this. Net profit as shown in the P&L. You can write prepared as per Schedule 3. And then add or less the adjustments specified under explanation 1 to section 115 JB. The first one is income tax which is there, or not payable, you can write down just income tax. Fine. So you will add back the amount of income tax payable and the provision which you have created, because you are taking the net profit which is there. So you will just add back the amount of income tax which is there. Okay. So add the income tax payable. Add provision for tax or the income tax which is payable. So I will not consider the profit which is including the tax, obviously. So therefore I will increase the amount of the tax. Are we clear? Secondly is the deferred tax which is there. So I will add back the amount of deferred tax which is there. So any deferred tax expenditure which is there, that also I will add it back. So just add the amount of deferred tax which is there. deferred tax less the deferred tax if it is credited to the P&L. So if let's say for example I have credited the deferred tax, there could be deferred tax asset which you will credit and the deferred tax liability which you will debit. So less the deferred tax credited. So that I will reduce it off. Fine. This is the first adjustment. The second adjustment which is there is in respect of the amount transferred to the reserves. So just write down amount transferred to the reserves. Amount transferred to the reserves. So 115 JB provides that any amount which is carried to the reserves has to be added back. So add amount transferred to the reserves. So let's say I'm debiting the revaluation reserve or any other reserve that I have to add back. So what I have to reduce then? So amount which is transferred to the reserves is added. Then amount, if any, which is withdrawn from the reserve, if it is credited to the P&L, that has to be reduced. So less amount withdrawn from the reserves. So amount transferred to the reserve, amount withdrawn from the reserve. The third one which is there is the depreciation. The depreciation, or first you can write down the provisions. Provisions other than for ascertained liabilities. So remember, provisions are anything which are disallowed under even the normal provisions other than the ones which are for the ascertained liability. What is an ascertained liability, students? What is the ascertained liability? In the first class we had discussed when we were dealing with the PGBP. Under normal provisions also, where the provision for ascertained liabilities is allowed, and what are the ascertained liabilities? Yes, students. What is the provision for ascertained liability? Yes, faster. Provision for ascertained liability under normal provisions. And what does that mean, students? Yes, Mohammed, but it's correct. Whether it is allowed under normal provisions, Mohammed? Yes, students, faster. So provision for a certain liability. A certain liability means what? It's quantifiable, very good, Mohammed, and which is capable of being ascertained. So which is certain, identifiable and quantifiable, and which is capable of being ascertained. So you can exactly identify that, okay, this is the amount that would be certainly incurred. There is a certain liability. It is not unascertained. And it is capable of being ascertained, meaning it is quantifiable. Based on the past experience, you can quantify the amount. So that is the provision for a certain liability. It is also allowed under the normal provisions. And provision for unascertained liabilities are any which ways not allowed under the normal provisions and are also disallowed under the MAT. So you will add back the provisions which are there. So amount which is transferred for or set aside for the provisions for other than for ascertained liabilities. So add back the provisions for unascertained liability. So that will be added back. And basically, if you have withdrawn any amount, if you have withdrawn any amount from the provision, then that will be reduced. Less amount withdrawn from provisions. If credited to P&L. Okay, so that will be reduced. Then the next one is the provision for the losses of the subsidiary company. So fourth one is provision for losses of subsidiary company. So any provisions which are made for the losses of the subsidiary company, that has to be added back. So that will be added back. So this you have to add. Next is revaluation. Provision for the revaluation. Now with respect to the revaluation of the asset, transfer to the revaluation reserve. So I will add the amount transferred to the revaluation reserve. Amount transferred to the revaluation reserve, that I will add back. And I will reduce the amount which has been withdrawn from the revaluation reserve, which is credited to the P&L account. Because revaluation is also not allowed under the normal provision. Fine. Next one is the provision for the diminution in the value of asset. So provision for diminution in the value of asset. So if the value of the asset is diminished and any provision is there, so that particular provision will also be added back. Yes, students, is it clear? So all these provisions, if you look at the amount transferred to the reserves, or basically the provision for unascertained liability, provision for the losses of the subsidiary company, provision for diminution in the value of the asset, the basically are to be added back, and any amount which is withdrawn has to be reduced. Okay, so that is something which is there. Again, in respect of the reserves, that is the same provision which is there. Then you have the depreciation. Sorry, one more in the respect of the provision, which is the amount of dividends paid or proposed. So dividends paid or proposed. Seventh one is dividends paid or proposed. So if, let's say, for example, there are any dividends which are reduced from the profit and loss account. So that dividend needs to be added back. So dividend paid or proposed is to be added. Okay. Yes or no? So these are the provisions which are to be added back. So amount transferred to reserves, you can just make it one single point also in order to for you to remember also. So I'm just writing it as a single point. Provision for unascertained liability. Provision for loss of subsidiary company. Transfer to the revaluation reserve and provision for the diminution in value of asset and provision for income tax. All of this are to be added back. With respect to the income tax payable, this will include income tax plus surcharge plus cess as well as the interest on tax. So all of this will be added back. Okay. Now, next one is the depreciation. Now, with respect to the depreciation which is there, the provision says you add back the depreciation. See, under normal provisions, if I compare this with the normal provisions, there also you add back the depreciation. Here also you will add back the depreciation. Under normal provisions also you add back the provision for tax, income tax, interest, all of that. You add back the deferred tax. Here also it's the same. Amount transferred to reserve you add back under normal provision. Provisions for uncertain liability, losses of the subsidiary company, revaluation, diminution in the value of asset, income tax, dividend. All of this is same under normal provision. Even for the depreciation here they say the same thing, that you add back the depreciation which is there. So add the depreciation. But under the normal provision, you reduce the depreciation as per the Income Tax Act, because this is the depreciation which will be computed as per the Companies Act, Schedule 2. Here, you will not reduce the depreciation as per the Income Tax Act. Here, you will reduce the same depreciation, but excluding the depreciation on revalued assets. So here you don't have to exclude the depreciation as per the Income Tax Act. You don't have to reduce that. Here you need to reduce the same depreciation but excluding the depreciation on revalued asset. So in the adding back, I am including the depreciation on revalued asset, and while excluding, I'm just excluding the depreciation but excluding the depreciation on revalued asset. So in short, the effect of this is that I'm adding back the depreciation on revalued assets. So I am not including the depreciation and excluding the depreciation as per Income Tax Act. What in effect I'm trying to do is I'm just adding back the depreciation on account of the revaluation of the asset. Fine. So that is what is in effect being done. Next is so I have reduced the amount, I have added back the amount of the amount which is transferred in the revaluation reserve on account of the revaluation of the asset on the retirement or disposal of the asset. So that means the notional gain or loss has been added back. The actual gain or loss will be reduced. So you can write it over here. The notional gain, the notional gain or loss, the notional gain or loss on the asset is basically which is reduced under revaluation. Fine. So that is basically reduced. Now in the similar case, on the transfer of the units, on the transfer of the units of the business trust, where what happens is where there is a share of a special purpose vehicle is transferred to a business trust in exchange of the units allotted by the trust. Now, this is what we are going to learn in detail when we will be going to the REIT class. At that point of time, we will again be referring to that. So here you have to just write that you have to add back notional loss less notional gain. So you have to add back the notional loss and notional gain. So notional gain or loss on notional gain or loss on transfer of the transfer of the share of SPV, on the transfer of share of SPV to a business trust, in exchange of units of the business trust, in exchange of the units of the business trust. So any notional loss which is there on the transfer or on notional loss arising on the notional loss arising for the change in the carrying value of the units, that is to be added back, and similarly notional gain has to be reduced, or the notional loss on change in carrying value of units. Fine. So that has to be added and to be reduced. Whereas the actual gain or loss, the actual gain or loss on the units transferred on the units transferred on the units transferred which are there, that has to be added or reduced. So notional has to be added back and reduced, the gain or loss, and the actual gain or loss has to be taken into consideration. So you will add back the notional gain or loss and consider in fact the actual gain or loss. But as I said, this we will again take into consideration when we will do the business trust. So add actual gain and less actual loss. You can write down add actual gain and less actual loss. Clear? But do not worry, as I said, this point we are going to cover in detail when we will go to that particular class. Fine? Yes or no? Next is the exempt income. Income exempt under section 10 or 11 or 12. So income exempt under section 10, 11 or 12. Now in this respect, you will reduce the exempt income and you will add back the expense on exempt income. So you will reduce the exempt income and you will add back the exempt income. Clear? So that is about the exempt income, which is exempt under section 10, 11 or 12. Next is share of member in the AOP. Share of the member in the AOP or BOI where no tax is payable under section 86. Now again, this is what we are going to cover when we will do the AOP or BOI. That time we will again be covering this particular point. So do not worry about that. Okay. So just write it over here for now. Add the income less the expense. Sorry, less the income and add the expense. So less the income, add back the expense. Fine. In respect of the share of the member in the income of the AOP or BOI. Next is the income of the foreign company. Income of the foreign company, which is the capital gain on securities and secondly, interest, dividend, royalties and fees for technical services, which is chargeable at rates under chapter 12, which is chargeable at the rates under 12. So if I have the income, which is the capital gain on the sale of the securities, or the interest, dividend, royalties, FTS, which is taxable under the 115A, if such income is credited to the P&L account and the income tax is payable as per the provisions of the Act, and the income tax is at a rate less than the rate specified under the 115JB. So in that particular case, I will reduce this income. And of course, I will add back the expenditure. So in a case where my income is for the foreign company, where I have the capital gain on the transaction in securities or the interest, dividend, royalty or FTS, where these are chargeable to tax at the rate specified under those sections. And if the income tax is at the rate which is lesser than the 15%, then in that case, they will be outside the purview of that particular MAT provision. Okay. So just write down taxable at rates under the provisions of the Act being less than 15%. Being less than the 15%. So you will reduce the income and add back the expenditure. Next one is the income which is taxable, the royalties which are royalties in respect of patent which are taxable under 115 BBF. So royalties on royalties on patents chargeable to tax under section 115 BBF. So this is a specific provision where the royalties on the patents registered and developed in India are taxable under section 115 BBF. So if the royalties on the patents are chargeable to tax under 115 BBF, on that the MAT will not become applicable. So that will be basically reduced, the income will be reduced and the expenditure will be added back. Fine. Then you have the last particular point, which is as I said, in case of the foreign company, the capital gain or the interest, dividend, royalties, FTS, if they are chargeable to 115A. If the income is taxable at 115A, and in case the tax rate is less than, let's say, the rate under the 115JB, which is 15%. Then in that particular case, your MAT will not become applicable. Also, as I said, for a foreign company which does not have a PE in India and which is covered by the DTL, it is coming from a country with which India has a DTL. First of all, the MAT itself is not applicable if there is no PE. And this income itself will not be subject to tax. Okay, this income will not be subjected to tax. Yes or no? Any questions, doubt? Yes, students, any questions or any doubt? So these are the adjustments which are required to be made under 115JB. Now, last particular point in respect of the 115JB is the unabsorbed depreciation and the brought forward loss. So, brought forward business loss and the UAD. Now, if you have a UAD as well as the business loss, you will consider both of them separately. You will not combine them. So, in case of the unabsorbed depreciation and the business loss, you will reduce the amount of business loss or the unabsorbed depreciation, whichever is less. Okay. So, lower of UAD or the brought forward business loss. And if the unabsorbed depreciation or the brought forward business loss is nil, then no deduction will be allowed because that is the lower. If either A or B is nil, then no deduction allowed. In case of companies which have gone into IBC, insolvency and bankruptcy proceedings, for them the UAD plus brought forward business loss, aggregate of them both will be allowed. So for them, aggregate of both will be allowed. Are we clear? Yes, any questions with respect to the MAT? So these are the MAT adjustments. Now I am giving you the question for the MAT and you are required to solve that particular question. So this is not only going to be on the MAT provision, but it is going to be a comprehensive question, which is going to cover 115 BAA, 115 BAA, the normal provisions of the tax and the MAT. So all three have to be taken into consideration. Okay. So just I'm putting the question all across over here. One second. Give me a minute. Yes. So ABC Private Limited incorporated on 111, this should be 23, is engaged in the manufacturing of footwear and has set up a factory in the Northeast. It has reported net profit of rupees 80 lakh for the previous year. This should be 23-24. The following items have been debited or credited to the P&L account. Contribution to the Research Association eligible for reduction under 35(1) to 2 lakh. Expenditure towards in-house R&D 2 lakh. Depreciation as per books of accounts 40 lakh. Royalty received from patents developed and registered in India 10 lakh. Expenditure on royalty rupees 1 lakh. STCG on transfer of listed equity shares on the recognized stock exchange is 10 lakh. Assets acquired and installed or put to use during the previous year. Plant and machinery 1 CR, 20 lakh paid in cash, building 50 lakh. Company has employed the new employees to whom the salary paid was debited to the P&L account. The details of which are on 111, these all should be 23, 2 employees, on 1/12/23, on 1st January 24 and 1st February 24. 24125 employees, 18,000 in cash, 25,000 ECS, 28,000 check, and 11,000 in cash. This is salary per month and per employee. So yes, students, you are required to start solving this question. First, give me the tax as per the normal provisions. Yes, students, start solving. Okay, tell me the answers. First of all, students, tell me the net profit is 80 lakhs. So I'll start with my net profit for the normal provisions. Or tax as per normal provisions. This is going to be the first part. Net profit is 80 lakh. What about the contribution to the research association of 2 lakh? What you will do? Contribution to the research association of 2 lakh. Students, please be faster. Contribution to the research associations. Yes, allowed, disallowed. What will happen? Yes, students, faster. It will be allowed, right? Under 35(1)(2), this will be allowed as the deduction. So just reduce this. We will reduce this particular amount from the, this is I'm writing under the normal provisions. So 2 lakh will be reduced. This is reduced already. It is considered 100% is allowed. So no effect. Okay, this is already debited. Expenditure towards in-house R&D. Expenditure towards in-house R&D. The contribution is not paid to anybody else, but for the in-house R&D, it is being paid. So that is also allowed. So therefore, there is no further effect of this as allowed. On section 35(1)(1). Depreciation as per books of account, you will add back. So I will add the depreciation as per books of accounts. How much it is? 40 lakhs. Fine. Then royalty received from the patents developed and registered in India, 10 lakh. So this is taxable at the special rate. So I have added here. So I will reduce the income and add the expense because this is separately taxable at the special rate on the gross basis. So add 1 lakh less royalty income 10 lakh. So under section 115 BBF, which is there is a special provision. So you can write it over here. Section 115 BBF. This is a special provision for a resident who is there. It is not applicable to a non-resident. This is for the income which is derived by the eligible assessee, means a person who is resident in India. So for a resident assessee, the income which is there by way of royalty in respect of patent, so royalty in respect of patent developed and registered in India. It should be the patent developed and registered in India. What do we understand? Developed in India means at least 75% of the expenditure on that patent should have been incurred in India for any invention in respect of that patent. So Developed means greater than equal to 75% of expense incurred in India. So if the patent is developed and registered in India, the royalty which is there with respect of that patent which is received for the transferring the rights in the patent or for imparting the information concerning the working of the patent or for using that patent, that shall be taxable in India at the rate of 10%. At the rate of the 10% on gross basis, meaning that is no expenditure is allowed. So 10% on the gross basis without deduction of any expenditure. However, the assessee has to exercise the option of being taxed under 115 BBF on or before the due date under 139(1) before filing the return of income. And once the assessee opt for 115 BBF, then he has to offer the income in the next 5 years in accordance with this provision. If he does not do so, then for the next 5 years, he cannot claim this 115 BBF. It is similar to 44AB. 44AD, sorry. Under 44AD, if you go for 44AD, you have to go for 5 years. If you come out, then you cannot go for next 5 years. Here also, it's a similar provision. Option to be exercised before the due date of return of income under section 139(1). Option once exercised shall apply for next 5 AYs. If opted out of section 115 BBF in any AYs out of 5 AY, then for next 5 AY, 115 BBF will not be eligible. Section 115 BBF cannot be claimed. Like section 44AD. Okay, like section 4485. Now in this case, if you look at it, the royalty income is 10 lakh. Now 10 lakh minus 1 lakh is 9 lakh. Now if I subject to tax 9 lakh at the rate of 30%, then it will be 2.7 lakh. Instead, if I subject to tax 10 lakh on the 10% without allowing the expenditure, it will be 1 lakh. So, going for the gross basis of taxation is more beneficial on the royalty income, and therefore the assessee is advised to exercise 115 BBF. So, you can write a note over here. If the assessee claims the section 115 BBF optional tax rate of 10%, it shall have tax liability on royalties of rupees 1 lakh. It shall have tax payable on royalty of rupees 1 lakh. 10% of 10 lakh on gross basis. This is beneficial compared to the normal tax at the rate of 30% on rupees 9 lakh. Because under normal tax provisions, you will be taxable on a net basis. Of course, if you had more expenditure, then it might have been possible that the normal tax would have been beneficial. Let's say my income would have been 5 lakh. So on 5 lakh, if I calculate 30%, it is 1.5 lakh. Still, it is not beneficial. Let's say my income would have been, let's say, 2 lakh rupees. My expenditure would have been, let's say, 8 lakh rupees. Then on 2 lakh, if I calculate 30%, it's 60,000. Then in that case, the normal provisions would have made sense rather than going for the gross basis of taxation. Because in that case, you will have the lesser liability under normal provisions because the net basis of taxation makes more sense. See, here you cannot opt for 25% tax rate, which is for the previous year turnover 2021, 21-22. The turnover should be less than 400 crores. Here there is no information given regarding that. It is incorporated only on 1/11/2023. And here there is no information which is given for the turnover of the past year because obviously this is incorporated only in this particular year. So I will not be able to go for the turnover because it was not there only in that year. Alternatively, you can also take an argument. See, there are both the interpretations which are available. Since the company has been incorporated only in this particular year, one can obviously take an argument that the turnover criteria is not applicable only. So, if the total turnover in the previous year 21-22 is not there only, I can still claim 25%. So, you can take that argument as well. Both the arguments are valid. One can take an argument that 25% tax rate is not applicable, number one, because the company is incorporated in this year. It was not in existence. Therefore, the turnover condition never applies. The second argument, which is also very logical, that the turnover was not there only for 21-22, so it was therefore less than rupees 400 crores. It was zero. Now, zero is also less than 400 crores. Then I can take the 25% tax rate also. So you can write down over here. The company is incorporated in financial year 23-24. Therefore, one can take the argument that the turnover of company was zero for previous year 21-22 and therefore tax rate of 25% shall apply. Alternatively, one can also argue that the condition of the turnover is not applicable as company was not in existence in financial year 23-24 and therefore tax at the rate of 30% shall apply. Okay. But any which ways, for the 115 BVF, you have to write down, compare the tax as per normal provisions on net basis with tax under section 115 BPF and advise to assessee accordingly. Fine. Okay. In this case, I have advised him to go for the 1 lakh for the 115 BBF. So I'm adding the expenditure and reducing the income. STCG on transfer of listed equity shares. rupees 10 lakh. I will reduce it since taxable under capital gain. So it is considered in the business profit. I will reduce it. Assuming this is as per the income tax only. So less STCG, because no other information is given. So I'm assuming this is as per the income tax. Assumed as computed as per Income Tax Act provisions. Right? So 10 lakhs. Then the depreciation information is given for the plant and machinery. So plant and machinery is purchased for 1 CR. So the depreciation on this shall be 15%. So I will calculate the depreciation. Depreciation calculation. Plant and machinery, building, cost of purchase is how much? 1 CR. This is 10 lakhs. Less purchased in cash. So I will reduce 20 lakh. Okay. Or you can make the presentation like this. Opening WDV is nil. Okay. Opening WDV is nil. Then add additions 1 CR and 10 lakh. Okay, so this is going to be 80 lakh. This is 10 lakh. Closing WDV. And now my depreciation. Here it is 15%, it is 10%. It is not given on which date it is purchased. So I'm assuming it is for the entire 180 days. Assumed for greater than 180 days. Okay. So on 80 lakhs, I will have 15% depreciation, which is 12 lakh. And on this will be 1 lakh. Plus there will be additional depreciation at the rate of 20%. Again, I'm assuming for more than 180 days. So 80 into 20% is 16 lakh. So the depreciation here is 28 lakh and 1 lakh. Why I took the additional depreciation? Because this is engaged in the manufacturing. This is engaged in the manufacturing. So my total depreciation is 29 lakh. Alright. So less depreciation 29 lakh. Fine. Now the company has employed new employees to whom the salary was paid to the PNL, salary paid was debited to the PNL account. The employees which are hired on 1/11/2023, 2 employees. Now this is the company which is engaged in the manufacturing of footwear. So I will consider 150 days and not 240 days. So yes, whether more than 150 days? Yes. But here the salary is paid in cash. So here you will not get deduction under section 80JJAA because the salary should have been paid by account pay check. Now this is 2023. Again here the salaries are paid. The employees are hired for how many days? This is less than 150 days. So again, no deduction. Here it is less than 150 days plus the salaries which are there are more than 25,000. So here also no deduction. And again, this is less than 150 days and in cash. So no deduction under 80JJEE. Or let me just do one thing. In order to give you the deduction, I will write here account pay check. So this will be allowed for 80JJEE. Now this is in cash, which is more than rupees 10,000, and this is also debited to the P&L account. So you will disallow this also under 40A3. So first I will disallow under section 40A3 salary in cash, which is how much? 11,000 into 25 employees into 12 months. So 11,000 into 12 months into 25 employees, which is 33 lakh. Fine. And then I have finally here the deduction under section 80JJAA, which is with respect to the employee, which is only 2 employees. So 2 employees into 18,000 into 12 months into 30%. 129,600. Also remember the 80JJAA deduction which is given. Yes, the 80JJAA deduction is not given for one particular year. It is given for 3 years. So the deduction in respect of the employees which is given, this applies for the 3 assessment years. So deduction of the 30% is allowed for 3 assessment years, including the year of the employment. So you can write it in the chapter 60 deduction where you wrote 80JJAA. There you can write about this particular point. I think we have not written. So you can just write, consider writing there for 3 assessment years. Fine. For 3 assessment years. Now coming to my tax liability here, we are done with the question. Okay. So what is my total income? 80 lakh, 40 lakh, 1 lakh, minus 10 lakh, minus 10 lakh, minus 29 lakh, plus 33 lakh, plus 10 lakh. And then of course the royalties is also 10 lakh separately taxable. Okay. So which gives me total income GTI of 125 lakh. And the total income comes to 125 lakh minus 129,600. So 12370. 12370 400. 1 crore 23 lakh 70,400. Okay. Here my tax at the rate of 25%, I'm assuming here, I'm going with that, is 309,600 plus the surcharge at the rate of 7%. 216,482. 3309082 plus cess at the rate of 4%. So this is as per the 25%. If I'm doing the tax as per 30%, if I'm not going as per the turnover criteria, then the tax along with the surcharge will be 30% plus 7% and plus 4%. 4,129,734. This is all inclusive. Okay. So this is the tax rate over here. Now I'm giving you the homework that you have to compute as per 115BAA, which is 22% tax rate, and the MAT. So if I go as per the normal provisions, MAT will become applicable. So what is my tax liability as per MAT? And if you do not go as per normal provisions, then you will not have MAT, but you will have to go with the 22% tax rate. So just let me know in the next class what is the tax liability as per MAT and the tax liability as per 115BAA and what is beneficial. Okay, students? So we'll stop here for today and we have next class on 29th directly. So you have ample days to just finish this off. Okay? Yes, students? Okay? Thank you so much. See you in the next class. We can close the session.